All right, so in this video, I'm going to talk about a few basic concepts associated with the cost of capital and capital structure. So let's start with the real basic piece here. A firm obtains capital from fundamentally three sources. So some form of debt, so this could be bonds payable, notes payable, say some kind of debt basically, or liability, preferred stock, and common equity. So now within common equity, we have the common stock piece. We also have the retained earnings piece. So common stock comes from when a company sells shares of stock to the public. The company then receives capital as part of that transaction. In the case of retained earnings, if the company makes a profit, so if they have net income, so they have a positive net income, and they don't pay it all out in the form of dividends, then what is not paid out is retained, and that's where the retained earnings come from. So that, if you think about it, the shareholders own the company, and so if the shareholders own the company, the net income really in effect belongs to the shareholders. So it can either be paid out to the shareholders, or if it is not paid out to the shareholders, it is retained. And if it is retained, that is essentially an additional investment by the shareholders into the company. And so basically, that's where a company gets its money from, either some kind of money that's borrowed, preferred stock, or some form of common equity. That's basically where a company gets its money from. Capital structure is basically saying what's the combination of those three. So what proportions of the money came from the different places? That's the idea behind capital structure. Now, for a given particular level of risk, so for a given level of risk, a firm is going to want to have the lowest overall cost of capital. Why would that be? Well, if you go back to the prior video, in the prior video I posted about this, I had a little example in which I said if a company has a cost of capital or a rate of return that they need to earn to keep all investors happy of 10%, and then if they earn this, how are they doing? Well, basically, if I look at that cost of capital, that's the rate of return the company needs to earn overall to keep all the investors happy. So let's think about this. Let's sort of set aside issues of risk for moments. Let's kind of just sort of ignore issues of risk. Let's say that everything has the same risk in the whole world. Okay. So if that's the case, if my cost of capital was 50% as a company, I could only invest in things that would get me 50% or more. Well, that's probably not going to be a lot of things I can invest in. If I can get my cost of capital down to 20%, well, I have to get 20% or better. Well, that's still kind of high, but it's a whole lot better than 50%. And I'm going to find more things that would meet that threshold. Well, if I could get my cost of capital down to 9%, well, hey, I can find a lot more projects, a lot more possible investments that would get me 9% or better. So basically, the idea here is the lower I get my cost of capital for a given level of risk, the more possible investments and projects the company can find that will be profitable for the shareholders, which means we will maximize long-term shareholder wealth better with a lower cost of capital, because I can find more things to invest in that would be profitable, make money for the shareholders. So we want to have the lowest overall cost of capital we can get for a given level of risk. Now, that does mean we need to talk a little bit about marginal cost of capital and historical cost of capital and kind of compare and contrast those two. Now, I think it's relatively uncontroversial to kind of note that firm circumstances, firm risk, market circumstances, the economy, all of this changes over time, right? So things change for the company, for the industry, for the market as a whole, for the economy as a whole, things change. So as a result of that, we need to be very careful, and we should not use historical cost of capital figures. If I use historical cost of capital figures, it does not reflect current circumstances and risks and what the current situation looks like. So for instance, if I look at what the coupon rate was on some debt that the company issued 20 years ago, well, 20 years ago, the whole economy looked different. Interest rates look different. The inflation rate looked different. All kinds of things look different. And so as a result of that, and the company's situation looked different, the prospects look different, everything looked different. And so because of that, if I use a coupon rate on the company's debt from 20 years ago, it's not going to reflect the current risk situation that the company is facing now. It does not reflect current market circumstances. And as a result, it will not correctly assess the rate that investors are requiring now. And the reason we care about this is the rate that investors are requiring now is the rate that I need to essentially exceed in order to keep the investors happy. If I do not pay attention to the rate that the investors are requiring now, and I look at a historical rate, I could be way off base about what investors are expecting, and that could lead to me either having too high of a standard and I pass up investments that I should have otherwise invested in, or I have so low of a standard, I invest in all kinds of stuff, and it really won't actually increase shareholder wealth because I should be expecting more in order to keep up with shareholder expectations. So basically, historical cost of capital figures should not be used. I need to look at current market circumstances when figuring out what rate of return do I need to judge my decisions by. So what that brings us to is something called the marginal cost of capital. So the marginal cost of capital is the cost of capital the firm would face to raise the next dollar of capital in the marketplace today. And this is going to incorporate current circumstances and risks, and basically is going to be an assessment of what do investors expect of the company now. And I need to make sure that I am meeting or exceeding that, holding risk constant. Okay. Now, once you start varying levels of risk, then that means we're going to have to make adjustments, and that's a topic for another video. But holding risk constant, what that means is I need to look at circumstances today. And once I have circumstances today, I can figure out, well, holding risk constant, at least, I need to beat this threshold. So if I'm up here and I'm beating that, that sounds good. But if this is my threshold and I'm under here with these projects, that's not good, right? So we need to be looking at the marginal cost of capital, which is the cost of capital today. And that is the correct cost of capital to use when evaluating capital structure and ultimately making decisions. Hopefully this video has been helpful. Thank you so much for watching and have a great day.